RAROC, or risk-adjusted return on capital, is a method banks use to check whether a loan is truly profitable after considering risk. It is not enough for a loan to earn interest. The bank must also consider expected losses, operating costs, taxes, and the capital required to cover unexpected losses. The basic idea is simple. RAROC equals loan revenue divided by capital at risk, and in detailed form it can be written as RAROC equals spread minus expected loss, minus operating costs minus tax, divided by capital at risk. Spread means the interest earned minus the cost of funds. A loan is acceptable only if RAROC is greater than the bank's required return or cost of capital. Now, capital at risk represents the money the bank must hold to protect itself from unexpected losses, and this depends on default risk, interest rate risk, and the loan's duration. When interest rates change, the value of the loan also changes, and we estimate this using the duration formula. Change in loan value equals minus L multiplied by D multiplied by delta I divided by 1 plus I, where L is loan value, D is duration, I is current interest rate, and delta I is the change in interest rate. For example, if a 1 million loan with duration 3 faces a 1% increase in interest rates, the loan value will fall, showing there is interest rate risk and capital must be held against it. Capital can also be calculated using credit risk models, where capital equals loan amount multiplied by loss given default multiplied by exposure at default, and sometimes multiplied by a risk multiplier such as 2.66 for a 99.5% confidence level. Finally, the decision rule is clear. If RAROC is greater than the bank's cost of capital, the loan creates value and should be accepted. If RAROC is lower, the loan destroys value and should be rejected.